Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, which is a forum for the family office world. Michael Weisz has a real knack for finding unconventional opportunities and a strong entrepreneurial spirit. He cut his teeth in real estate, but quickly found his nuanced understanding of mispriced risk prepared him for creative investments like litigation and receivable finance and strategies like loans to professional athletes during lockouts. We talk about the development of the Yieldstreet platform, how they think about the wide variety of offerings they have, ranging from fine art to CLOs, the democratization of finance, and the international scaling of the firm. Michael is the co-founder and CEO of Yieldstreet, a leading private market investment platform with more than 450,000 members and $4 billion invested. Before Yieldstreet, Michael held a variety of positions across the specialty finance spectrum, including founding Soli Capital, which specialized in litigation finance. Previously, Michael was vice president at a New York-based credit opportunities hedge fund with over $1.2 billion under management. Please enjoy my conversation with Michael Weisz.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
So you have this scrappy entrepreneurial background, even when you were a child. Can you tell us about some of your first endeavors?
My first endeavors, sure. My first most memorable endeavor was probably the first time I learned about payment terms. So there were two bus routes. When you were a little bit older, you had to go an hour before. The kids who were slightly younger, I think it started in sixth grade. And you'd go to school and you'd pray and then you'd have breakfast. And then after breakfast, you'd have class. So I guess the younger kids didn't have to come to the school prayers. They would just come in for breakfast and then class. So my next door neighbor was a little younger than me. And so the same bus driver would do the route twice. So I made him a deal that if he picked me up last on the second route, I'd give him a bialy and cream cheese every day. So the bagel store was around the corner. So I would leave the house on time. My parents, of course, thought that was going with all the kids my age appropriately on the first bus. In reality, I walked to the corner, hang a left, and I'd go to the bagel store. I got terms from the bagel store to get an assortment of bagels, and I'd have to pay them the next day. So bagel and cream cheese was 99 cents. Bagel and butter was 50. 2 eggs and cheese was $1.99. And I would sell them for $2, $3, and $5 in school. Cash business, it was great. Learned about payment terms. But jokes aside, I think that there's always a bug in me that had this entrepreneurial spirit. I enjoy it very much. And I think it's been a part of who I am since as young as I can remember.
And of course, you made up your prayers later, right?
Not everything is meant for between me and God.
And so what about high school? Did you try to start any businesses in high school?
I think in high school, I wouldn't say that there was a particular business that I started. I think I was always just dabbling in different things. It could have been cards. It could have been other things. I would try to find a trade, try to make an extra buck here and there. I went through that itch as a high school kid in trying to trade stock. It started with my fake portfolio on Yahoo. Then I got a couple of bucks and started investing in it. So to give you a little perspective, I'm 35. My sort of younger, early adolescent years were very much in the go days pre-2008. And so you would walk around town or you would go to a local event, a wedding, a bar mitzvah, or a Saturday afternoon, and people were talking about the stocks that they were investing in and what was going well and what wasn't. And the real estate guys were talking about their deals. And so I think by osmosis, even though I didn't grow up wealthy or in a family that was on Wall Street or in real estate, it just very much was something I was like, I want a piece of that. I feel it. You see all the successful people being concentrated in these industries. And as a kid, I just wanted it a lot.
So tell us about your early real estate exposure and experience, and tell us how you learned the game.
It was painful. It was a grind. I think the most important lesson I learned during that time was resilience and rejection. And I think that resilience and that rejection made me realize that you just got to keep fighting through it and you have to keep going for the next one. I started out what I would say equivalent of cleaning toilets. So I was looking to help real estate owners find the right financing on an acquisition or on a refinance of a property. And so there were two sides to that business. One, you had to find prospective prospective owner operators, the guys who own the real estate. And then on the other side, you have to find a lender or a bank that would be appropriately matched for that opportunity. And so I'll never forget it. I had two phones. I made 125 calls every day, no matter what. And of those 125 calls, if you were lucky, 20% of the people picked up the phone. Of that, 20% of the people stayed on for more than 10 seconds. And so there's a tremendous amount of rejection. Then once you land a client, you're super excited. You start working through the deal. Somebody older or more experienced is usually going to partner with you on that deal and share that commission and really help you learn the ropes. And so in many ways, I really started from what I would consider the lowest possible spot within the ecosystem where you don't have anything guaranteed. You had to find both. And even after you found the client and did all the work, you could potentially not find the right bank or a suitable bank or terms that your client would accept. A lot of rejection, a lot of bottoms up, no easy shortcuts to becoming successful or to getting really good at what I wanted to do. And I think I figured out pretty early on that I have a lot more drive than most people. And I think you have to have humility and respect for the experience that other people have. But I think there's also a pretty simple approach to getting a leg up on them, which is working harder and longer. So if someone's going to come into the office casually at 10 and leave at 5:30, but I'm going to come in at 7:30 and leave at 9:30 or 10, especially when I was younger and had very little responsibility, it won't take that long for me to catch up to the experience that some of these older people had. And so I just got obsessed about putting in more hours, learning more, attaching myself to the best people in the industry, having the humility to just say very openly, I want to learn from you. And I want to be the best at what we're going to do here. And the only way to do that is either make the mistakes myself or find the right people to teach me through it. And you'd be surprised once you open up in that way, people are really keen to want to be your mentor and want to be helpful. And I think they take a sense of pride in you coming to them. And I think I said a lot there. We put a lot of that together and it's helped me become who I am today.
Sales involves a lot of tenacity. Did you have a special strategy for dealing with objections?
Jewish parents. Yeah, listen, I was a bit of a troublemaker as a kid. My parents are incredible and they're amazing. But between the discipline that I was required to eventually become a good, positive, functioning human being in society, I think I learned a little bit about tenacity.
So did you think about going full-time into real estate? Did you think about becoming a broker?
I definitely did. I would say a few things. One is I have enormous aspirations, enormous, not normal for most people aspirations. And so the brokerage part is not what got me excited. It was the idea to shape a city skyline. That was really what I was excited about. Growing up in New York, coming to the city from time to time, seeing the skyline develop and change over that time, and realizing that the people who were creative enough to build and construct the buildings that we see in every major city, look at what's happening in places like Miami, or you go even further out in the Middle East, those buildings are going to be there for hundreds of years, and they're shaping the cities and changing the cities, and they're changing how people live in cities. And I thought that was really exciting, how you can leave an indelible mark on a city in a major way and really enhance the lifestyle that so many of its inhabitants have. So I think for me, the development was the most exciting part over time. But my story took a turn, right? The financial crisis came, and real estate lending and investing had really shut down in a pretty material way quickly, unless you're at the top of the game with a lot of liquidity. And I wasn't there yet. On the flip side, there was a tremendous amount of need for capital and a dearth of capital available in traditional sources. And I had an opportunity to join they called them hedge funds at that time. Today, we would call them credit funds, because they've gotten more defined over time, where the idea was find good risk-adjusted opportunities. We want to be asset-based lenders. So worry about what happens when the glass breaks, then figure out how to make money, understand the downside, and let's be creative with our capital. We're going to charge as close to 2% a month as we can, because we can, and then let's go build a business. And to me, that was really exciting, because coming from what I was doing in real estate, which we just discussed, I had to get the bank and the client. And so I didn't control any side of the trade. And so you're like this sort of naked guy in the middle of the ocean, not sure where to go. Whereas here, at least I was tethered to know that I could provide a value that I was able to execute on if I found the right opportunity. And so the money was good, I just needed to find the right investment opportunity. So that gave me a very different way to approach the market and a very different way to control my own destiny. And so I got really excited about that opportunity. I did a lot of interesting and different things. I had the sort of the need to be very creative and be a problem solver. And I think at my core, like that's where my entrepreneurial kick comes from. Even if you think about as dumb of an example as like the bagels as a kid is, like people hated the school breakfast. And so I was like, okay, how do we fix that? Or when in 8th grade, the school decided to bring in these new beautiful lockers, but it would cost each kid $120, I think. But it was an all boys school. So if you got one, all your brothers could have it. I didn't have any brothers in school. So how's I going to get my parents to give me $120 in the middle of 8th grade? But if you didn't have that beautiful, brand new, tall locker, then are you really the cool kid? And so I went with a friend and we convinced our parents to buy a bunch of them and we subleased them. We got these dividers in Costco and we loaded up the bottom with snacks and we charged people like $50 and we subleased a bunch of them. And then the school couldn't sell any lockers. Funny side story. I got suspended for that, but they loved the ingenuity.
Are you still getting income from those lockers?
Yeah, I rolled them up, put them in a REIT, took it public. It's been amazing. But jokes aside, that principal who couldn't stop laughing when he had to suspend me is now my kid's principal. And he's great. He's really awesome. But again, it was born out of a desire to problem solve, right? And to create value while I was doing it. And I think I quickly realized that the more value you create for others, the more value you will create for yourself. And that exists pretty much across every business, maybe with the exception of like trading. But there are very few ways to become incredibly successful if you're not going to create value for others at scale. And I think that's a common thread throughout my journey.
So before we get to Yieldstreet, I'm interested in what your first exposure was to litigation finance.
It was very strange. We talk about something, we call it in Hebrew, we call it mazel. I think other people call it luck. Sometimes things just fall in your lap. So I had a knack of doing funky things: receivable finance, purchase order funding, loans to professional athletes during the lockout. And I used to think about things as the difference between perceived risk and actual risk. People see something messy or not completely scalable, and they automatically assume that it's much more risky than something like a securitization for mortgages, which seems like so perfect and homogenous, and there's a whole market for it. I don't quite see the world that way. I think you have to understand where's the collateral, ultimately, what's your risk return here? And so I had an knack of doing that. I had a reputation already. The right brokers, bankers in that universe knew to call Michael if you had an interesting deal that really was well secured and needed different capital or needed it quickly. Anyway, I get a call from a lawyer on the West Coast, and he says, "Hey, I got your number from so-and-so. He suggested I give you a call. I need like $20 million in 3 weeks to make payroll." So that was a red flag because brokers don't tell people to call you because they always want to be able to charge a fee. So I said, "Why isn't he calling me?" He said, "He thinks this idea is crazy." But he said, "If there's anyone in the world who would look at it, it would be you." I said, "Okay, you're not off to a great start." Long story short, he walks me through the scenario. And the way he explains it is, I have a pretty reasonable size law firm. I'm pretty well known here on the West Coast. I think I'm going to make $300 to $400 million over the next couple of years. We're what you call a contingency law firm, which means that we don't get paid hourly. We only get paid if we win a case. And I'm going through a cash crunch now for whatever reasons, but I have a great portfolio of cases. They're very well diversified. I've made a bunch of money before. I just spend like a drunken sailor. And I'm going to continue to make a bunch of money, but I'm really down to payroll. I had a lender who has been funding us, but because of the crisis, this was like 2010, late 9, I would say, late 9. So because of the crisis, the lender just backed out and isn't being able to fund me. And we usually get funded once a month. So I got 3 weeks to figure out payroll. So I said, "Listen, super interesting. I am not a lawyer. I don't know anything about the law. And I'm probably not your guy. And I'm certainly not your guy in 3 weeks for this kind of money." He's, "Listen, I really think it's compelling. I think you can do super well here. I put together a summary brief on what the opportunity is. Would you take a look at it?" I said, "Sure." I make a call to some people I know, and I get in touch with a very senior lawyer at a major firm and a former judge. And I reach out to both of them, tell them a little bit about it, send them the one pager. They both call me back within a day or so, and they're like, "Hey, we know this firm. This guy's a real player. It's a serious operation. You should take this seriously." So that was my first foray into the space. Ultimately, to just roll forward to the deal, what I realized was exactly that is perceived risk versus actual risk, right? There were a couple hundred cases in the firm. Half of the firm's cases could have gone to zero and we still would have gotten paid 10 times over. And so it opened my eyes to a whole new world. There was really nobody doing law firm lending at that scale or litigation finance in the US at the time. The only two players that were doing commercial litigation finance was Juridica, who just came in. At that time, I actually did the first deal with Juridica in the US with Richard Fields. And the second was Burford. And there were a couple people out of Credit Suisse who were now Aaron Katz and others who were doing it, but very early realized that there's a huge business to be had here. And people don't understand how the collateral works. And so the whole risk return is just totally mispriced. And we had an amazing run in that business for a very long time. And we continue to be a meaningful part of that ecosystem. But it's been very rewarding to see how that business has evolved over time. There's been yield compression over time. There's been a lot more capital entered the market. But that's how I got into it.
So day one, founding of Yieldstreet, how did you guys kick the flywheel?
Yieldstreet was interesting because I've been frustrated about a few things for a long time, and I didn't know how to deal with that frustration or how to solve it, if you will, till the founding of Yieldstreet. The net summary is, for too long, the best investments have been reserved for the fewest people. And it hit home. It hit home through family experience, through friends' experience. '08 really shook me up in a way where I was very young in my career and I was starting to be successful and I was getting very lucky and working very hard. And I realized that it wasn't just about doing the right thing that made people successful, because so many people did the right thing, meaning worked hard, saved, put their money in the traditional ways that they were told to, and then their portfolios got rocked. And blaming people for freaking out and taking their cash at a low is wrong. It was wrong for them to do it, but you can't blame them for it. It's actually very understandable why they did it, right? They trusted the system and look what happened. And they never recovered from that. And so on the other side, as I crossed into this private market world and making 2% a month plus, it was just such a dichotomy of the small few in the club who had access to capital and participated in this world, and everybody else. And I wanted to be a part of solving that. I wanted to find a better way to give people access to financial independence, to financial freedom, to make more money. I think we all want a better life for the next generation than we were afforded for ourselves. For me, that's very real. My grandparents were in the Holocaust. Some of them had much worse outcomes or impacts than others, but they all started over with nothing. And they built a beautiful family and they gave their children opportunity. And my parents gave me opportunity that they didn't have. And I'm now giving my kids the opportunity that I didn't have. So being a part of that, I think, has been just hugely important to me. I didn't know how to do it. What happened was there were three things that came together. One, the Jobs Act. So if you recall, before the Jobs Act, which people tend to forget, it wasn't that long ago, it's 2014, but any fund just had a website. And it was basically a disclosure and the picture of the city skyline where they were. That was it. And it had like a username and password. I suspect there was no functionality behind it, except maybe just like the tear sheet. But there was no marketing. So you couldn't really find an affordable, scalable way to bring people into private markets. And that changed with the Jobs Act. The second thing was, let's even say that you could market to investors. How was I going to do that? Take you out for lunches and dinners? I'd be Oompa Loompa by the time I got to meet half of my customers. And so we needed a scalable solution. What was happening at the time was this sort of huge move to the internet, right? People were flocking to places like Instagram. Well, Instagram wasn't even around. Facebook, Google, LinkedIn at a rate that we've never seen before. And so that meant that all of a sudden you can now use an online digital funnel to try and create a huge network. And you could do it really affordable. So if you say Google or look for Four Seasons or First Class Ticket or a Porsche or Loro Piana or any sort of somewhat more elevated experience, we can start marketing to you in a way that we couldn't before, very affordable rates. And then bringing the legal, the marketing, and the technological capabilities to make the experience beautiful together really only came about at that time. And that's what allowed us to become who we are.
So technology was key to all of this. How did you learn to work with technology and developers?
So I was very fortunate. I started the business with a co-founder and a partner named Milind. Milind and my background couldn't be more different, but our resolve around the mission of Yieldstreet couldn't be more in unison. Milind's background was he was born in India, came out to the US to go to college, was a technologist at heart, worked in a couple of technology companies. Most recently, before Yieldstreet, he had founded a company called Yodel. And Yodel was like the first sort of version of Yelp, if you will. They ultimately sold to web.com. And Milind had deep expertise in understanding how to bring global local. So how do you bring people through a funnel? And he had deep experience with product and engineers. My experience was on the other side of the house of the business. And so we understood from day one that there was a gap in what people refer to as the fintech market. I think fintech quite literally is supposed to be the fusion of financial services and technology. Realistically, when you look under the hood of most companies in this space, you'll find it's either led by a financial services expert or a successful entrepreneur who then hires a CTO, or a successful technologist who hires someone with deep finance background. The culture of the firm is a function of its leader. And so when you have a financial services CEO who hires a CTO, you're going to have shoddy technology and a bunch of finance people running the business. If you have a technologist, you're going to have beautiful technology and limited commercialization. And we've seen that consistently throughout the startup ecosystem. What Yieldstreet benefited from was the two of us were incredibly passionate and very much co-managed the business for a long time. And so the balance and appreciation for product and technology, but the requirement to have sound controls, system, governance, appreciation for the regulatory body, investment processes, asset management, et cetera, that's what separates Yieldstreet in a big way. So I think in the early days, having Milind as a partner to co-manage the business was really helpful to creating who we are today. And ultimately, we have built the most sophisticated distribution infrastructure for private markets in the world. And I think it's a function of making sure that we had the two disciplines leading from the top.
What was the moment like when you knew it was a real business?
It was euphoric. It was really euphoric. I have the goosebumps thinking about it now. It was when
did you know?
I knew in 2019, we started to scale our offering from millions to tens of millions a month. And all of a sudden, these investments were selling out in fractions of a second to hundreds of people. Like we sold a deal in less than 1 second to 400 people. That is insane. That is literally insane. Impossible without technology. And so realizing that there was such a tremendous pent-up demand and that the desire to complete your portfolio with alternatives was real, it was a euphoric moment.
So there was AngelList, there was Circle Up, there was various Craigslist versions of crowdfunding. How did you learn from these early efforts as the space matured?
What I'm going to say may come off as boastful. It's really not. I don't want it to. We didn't learn from them very much. We charted our own path. We had a fundamental different view in what we wanted to build, and we didn't build what they built. We didn't build what any of them built.
What mistakes do you think they made?
If you don't mind, I'll rephrase the question. What do I think we did right? And I don't love talking down on others. So here's where I think we understood something that nobody else was paying attention to. Number one, my vision for Yieldstreet is to build the one-stop shop for alternatives. Anyone who wants to buy alternatives, anyone who wants them in their portfolio should be able to get them through Yieldstreet globally. That's a massive vision. How do we do that? It starts with the customer. I obsess over the customer. I am the customer. I've always been top 25 or 35 customer on Yieldstreet. And so when you think about who you're really serving, and if you're serving the investor, then what is it the investor wants? My belief is, and our belief at Yieldstreet, is that the investor wants to be able to have a seamless, beautiful experience, to have a diversified portfolio of alternative investments. Now, there's three types of ways to do that. There's three different experiences. There's do it yourself. I'm going to go and pick the different investments. I'm going to create my own portfolio. There's the guide me. I still want to make my own decision, but I want some help from you. I don't want to pick individual real estate offerings or individual private credit offerings or private equity offerings, but I know I need that in my portfolio. So I'll tell you a little bit about me digitally or humanly. And then, you'll serve something up on a menu to me and I'll pick one. And three is do it for me. That's a managed portfolio portfolio or a robo solution in alts. So I think those are the three ways that anybody would experience investing in alts on behalf of themselves or their clients. What that means is that my job is not to find the best real estate deal today and sell you that every day. Our responsibility is to find the best risk-adjusted opportunities and provide you the vehicle in which you could diversify a portfolio of alts. Everyone else built a monoline business. They wanted to be great at one thing. AngelList at startups, someone else at real estate, someone else at art, someone else at something else. That made no sense to me. Where in our life were we continuing to double down on domain expertise? When I grew up, I went to the baker, the butcher, the flower shop, every single store along the main street in the neighborhood to pick up the things my mom asked for. It doesn't exist today. I go into Whole Foods and they're all there. When I was starting out in business, we had a StarTAC and a Palm Pilot, and then a Nokia and a BlackBerry. And now I have an iPhone or someone else has an Android. The way we used to live. Today, you have your supermarket and your cleaners downstairs. You got office towers in the middle and you got resi on top. The whole way in which our life and the consumers experiencing things is to try to do as much as we can in the easiest way possible. For whatever reason, everybody was going after a monoline business, assuming that I was going to go and have 15 different usernames and passwords, and I was going to try and build trust with all these different platforms. Well, trust is really hard to build and really easy to destroy. And so for us at Yieldstreet, it was all about understanding. I like to think of IKEA, for example. You ever went to an IKEA? So you go into the store and there's arrows all over the store, right? Someone approaches you and says, "Hey, how can I help you through the store?" And they navigate you through the store. There's no such thing as turning around and walking back out. If you want to get out of IKEA, once you go in, you got to go through all these arrows. Yieldstreet's the same way. You show up to Yieldstreet in one of many ways. It could be a different ad. It could be a financial advisor. It could be a referral source, whatnot. You come and you get a big hug and we say, "Hey, how do we help you build the best portfolio for you?" So that's the biggest difference when you think about Yieldstreet. And as a result of that, there is so much more that we have had to do that have separated us from everybody else as a result of that first decision to start with being obsessed with a customer.
Do you ever fear that the future of this space ends up being Schwab or Morgan Stanley?
I know it will. I just think we'll power them.
Why don't the big players dominate this space now?
Why don't the big players ever dominate innovation? Same reason. They move too slow. They have legacy technology. Risk tolerance isn't there. They'd rather wait and see how things will evolve over time and then jump onto the bandwagon. They have no choice. Vanguard, Schwab's, E-Trade, TD Ameritrade, Robinhood, Fidelity, all of them. The entire narrative has shifted to a healthy portfolio must include a fundamental portion being alternatives. And so they are losing market share, and they'll continue to lose market share, wallet share, I should say, until they provide their customers what they really need, which is a complete portfolio. They will do it. And I'm sure once they do it, it'll be great, but it's going to take them some time to be able to offer a holistic, seamless experience. What we have built doesn't exist anywhere in the world, and it will take years for someone else to build. And so I think the future of Yieldstreet is about powering some of those major platforms, as well as continuing to provide people with a self-directed experience.
What's your distribution like? Do you guys have a big marketing budget, or do you have multiple sales teams?
Our distribution is primarily a digital experience. And so historically, Yieldstreet has really focused on the self-directed investor. So we've really been focused on the wealthy consumer who's looking to be more involved in her portfolio and to invest 30% or so of her portfolio in alternatives. Over time, we've expanded our distribution capabilities. With the acquisition of Cadre also has half of their AUM sits with family offices, institutions, endowments, and major corporations. And so this gives us a new vehicle to distribute a more holistic portfolio to those clients. So in 24, we're going to start to offer private credit, private equity, and other private market solutions to a lot of those clients and continue to expand that. Additionally, we have a partnership with Luma, which provides structured products to thousands of advisors who started to offer their advisors a host of products from Yieldstreet as well. By the end of the year, Yieldstreet's going to look very different than it did last year. By the end of 2024, we have two pillars that are really our core moats at Yieldstreet. One is the most sophisticated distribution infrastructure for private markets. And the second is this beautiful digital native experience. And the two of them, when fused together, really create the magic at Yieldstreet. What I mean by that is the next level down. The investment arm of Yieldstreet is run by a gentleman named Ted Yarborough. Ted is our chief investment officer. Ted has been with Citi for over 30 years. Incredible sort of history and career, managed over $100 billion globally for Citi. So he runs our investment team. And the way I would think about that is you have a tremendous amount of opportunities. For 23, we saw over $10 billion of investment opportunity. We funded a little less than $1 billion. So he runs a really rigorous funnel and a process, but you'll see tons of opportunity come in on one side. And then the question is, okay, how does it come out the other end? What's the distribution capability? And so we already discussed that the distribution capability is 3 experiences: do it yourself, guide me, do it for me. And then the audiences are self-directed, RIA, so B2B to C, and then institutions, endowments, and family offices. That doesn't exist anywhere in the world, and that's what we're building, and that's where we continue to go.
Do you have separate deal teams for each of these channels? How do you find new opportunities?
Each asset class is run by someone who has substantial experience in their space. For example, you had mentioned, Laura, we bought Athena Art Finance from Carlyle in 2019. It is the largest independent art finance business in America, maybe even in the world, after Sotheby's. That business is run by a team that's been there for a long time. There's continuity, there's deep expertise in the market. If you look at our real estate business, we have 2 sides of it. We have the legacy Yieldstreet real estate business, which has secured debt, SFR, BFR, so single family rental and build for rent, and real estate equity, which we specialize in sort of $7 to $15 million equity checks. That's run by Mitch Rosen. Mitch has been in the real estate space for 25 years, deep expertise in major operations, and the same would happen across the team. So Ted's got some incredible talent running each of the asset classes and each of the strategies at Yieldstreet. And what we really pride ourselves on is being a distribution platform, less of an asset management platform. And so what each of these leaders are looking to do is find best-in-class sponsors in each of their respective business units to partner with and to scale. And so what we look for is homogeneous, scalable supply. So we're looking for partners that we can do 20 million this month, and if it goes well, 50 million next quarter, 250 million or 500 million next year. And so if you look across the partners that we invest alongside, they're usually going to be multi-billion-dollar shops with substantial track records. They're often top decile performing in their respective areas. And what we look to do is leverage our technology, our beautiful user experience, and our community of investors to scale dollars and distribution.
Have you ever come across any assets or cash flows that were too complicated to fractionalize?
Guy sent me a deal yesterday. Hey, it's guaranteed by the DFC, which I think is the Development Finance Corporation of the US government. It's providing some resources to Egypt, Angola, and some other place. Not interested. Maybe he's right. Maybe it makes a bunch of money. Not interested. Can think of 10 reasons why I'm not excited to be in business in those areas, and trying to explain that to our audience and seeing if it's scalable and doing all the diligence and feeling comfortable to stake our reputation or our brand. Not for me. I was taught something very young, going back to child rearing that we joked about earlier. When I would study with my dad, he would always tell me, if you can't explain it to your mother, you don't know what you're talking about. And I've lived with that throughout my professional career as well. If it's not easy enough to understand why someone's coming to you for money, what is their business, and how are they going to pay you back? Not for me. Move on.
Is there a syndication aspect to this? Could you build a fund on top of Yieldstreet?
Yeah, we do have funds at Yieldstreet.
But could you build your own fund on top of Yieldstreet?
Why not? That's not who we want to be right now. I think for an entrepreneur, the single most difficult part of the job, in my opinion, is prioritization. Right? We're creative people by nature. We're excited about what isn't and what could be. That's why we build businesses. So being excited about the next shiny thing, it's a very easy trap for an entrepreneur. And maintaining the discipline for relentless prioritization, to stay on your path, to march towards your vision, to understand cost-benefit analysis, and to stay focused and keep going, that's the hard part. So we've toyed with that idea in different forms over the years. Like during the SPAC craze, people were running to us and saying, Michael, you'd be perfect. Do Yieldstreet SPAC, be a sponsor. Like, you have the balance between an investor and entrepreneur. Let's go. And super enticing. The economics when they were working were unbelievable for some of the sponsor teams. And I was like, no, like that's not our responsibility right now. That's not what I'm here to do. I'm here to build the most transformative alternatives business that ever existed. And we're on our way and we're going to do it. And you know what we have so far? Right now, we're 5 times bigger by revenue, maybe 4 times if I want to be conservative, than the nearest market participant. Got to stay focused.
I'm sure you get asked this a lot, but what about alts in general? You have this huge database. Why not offer them access to private equity and hedge funds?
So one of our business lines is we call third-party funds here at Yieldstreet. And we go and we identify what we think are two criteria. There's top performance, right? Long-standing top performance. And then there's does it fit within the broader diversified portfolio theory that we have. And so if you go on Yieldstreet today, if you're a QP, you might see Ares Sports and Entertainment. You might see a KKR fund that we're offering. So we've worked with a lot of top decile performing fund managers across the spectrum. So there's Onyx, Falcon, the credit. There's, like I said, KKR. There's Ares Sports Media Entertainment, Avenue Capital, Bonaccord GP Stakes, Aviator specializes in aviation leasing. So we're very actively looking for the right managers, scaled managers that have a great track record to provide access to investors at a much more affordable price point. And we're often doing so with better economics because we could speak for scale.
It's been 10 years. What are the demographics of your investors? Have you seen patterns?
We've seen patterns, but we also control patterns. Right, because the demographics of our investors are a function of who we target to be our investors. And so I would say our core customer today is on the more affluent side of the mass affluent market. It's going to be 500,000 to 5 million of investable cash. We're going to target 30% of your portfolio, so 150 to 1.5 on average. I like to think about that in terms of what I would call my platinum card customer. My Centurion card members, to use the American Express categories, my Centurion card is going to be ultra high net worth, family office, endowment, smaller side. So those are going to be your multi-million dollar investors. And then we have quite a bit of gold card customers, which are very intentional about having a healthy portfolio and a well-balanced portfolio. They may not have as much capital as a Platinum or Centurion card member yet. It could be young professionals, lawyers, doctors, dentists, others, which we think will ultimately grow into becoming the Platinum customer and beyond. That's our core business. At the same time, we have very deeply rooted in what we believe in at Yieldstreet is that everybody should have access to alternative investments, and we want to be a huge force in democratizing that access. The reality, though, is back to the last conversation about prioritization. You got to be careful about how you use your dollars, and you still have to make sure that you're building a business that's going to create enormous shareholder value. And so the unit economics on the non-accredited investor, on the much smaller investment size customer, just don't really support the type of business that we're looking to grow right now. I think that's also where a lot of folks went wrong, is they blew enormous amount of capital on trying to get the most number of users, not paying attention to the wallet per user and the fee per user and the cost per user. And so over time, we've migrated away from the smaller customer, but true to our belief, we've kept two products available to non-accredited investors as well. And that's the Yieldstreet Alternative Income Fund, which is a 40 Act fund that has a diversified exposure across a lot of what we do at Yieldstreet. We put pieces of what we invest in across the business in this fund. So you get broad private market and alts exposure. And then we have the Yieldstreet REIT, which is a income and a growth REIT. And it's got a combination of debt and equity in that REIT to give people a balanced exposure to real estate. That's a little bit about our customer. There were times where we were focused and made that same mistake that others do on a more mass market. And while I think we altruistically want to be there because we believe in making alts available, it would be better if we could do it in partnership with somebody who has a scaled user base of non-accredited investors, so we can get to them without having to incur the cost and provide the experience, even if the economics wouldn't be as attractive as focusing on our core customer.
One of the major issues with the RIAs, especially as they've grown over the last 10 years, is the customer acquisition cost goes up if you want to get the larger customers. Have you seen the same pattern?
Not materially. I think that, and I'm not sure that in absolute terms it matters as much. I think the CAC to LTV ratio is what you should be focused on. So if it costs you $1 to get a customer, but you only make 50 cents, that's a bad trade. If it costs you $10,000 to get a customer, but you can make $100,000 in a year or two, that's a great trade. So I think people try to hone in on one KPI and assume like that's the most important component. I think that when folks try to oversimplify the business, I tend to get wary of it. I like a more fuller picture. So I think that if you want to corner like the higher end of the customer, it's certainly going to cost you more, but you're going to make a lot more money on that customer. So I'm much more focused on the CAC to LTV ratio than I am on absolute cost.
And how complicated is it on their end? Do they have to deal with 1099s and K1s? Are they, in a sense, buying the platform and not so much the access?
So it's a two-part question. I think it's not complicated at all. You also just gave me a clue that suggests that you're not an investor. So now I'm on your case. We're going to get you to try it. I don't think there is an investment experience in the private markets that is even half as easy at Yieldstreet today. It is seamless. It is beautiful. It is smooth. It is not perfect, but it is amazing. And it's getting better every day. That's feedback that we get across the board. So I don't think it's complicated. I think you'll find it engaging, enticing. I think you'll find it like, someone finally figured out how to make all the stuff I hate doing go away. Like the myriad of documents you have to fill out. No mas. You don't need to do that anymore. As you onboard to the platform and you fill out your information, we're smart enough to figure out how to take the right pieces of data and incorporate them in the documents on an automated basis. So there's a lot that we do behind the scenes, all with technology, that makes your experience beautiful and simple. And it doesn't end when you invest. A lot of businesses focus on converting a customer. So top of funnel, the marketing, the ads, the front end of the site are going to be beautiful and you're going to enjoy it. And then you're going to make the investment and you're going to be like, what the bleep is going on? What happened to the experience? That's not us. End to end, we care about your experience and it's simple and it's beautiful. Second part of your question is about K1s and 1099s. No, you're not buying the platform. You haven't figured that out yet. So you are buying ultimately the individual offerings or the fund that you go into. So if you buy, let's say, a 40 Act fund, sure, very simple. You get a 1099 and you have broad exposure. If you're building a portfolio on your own and you're curating a series of assets, then you're going to have a combination of 1099s and K1s. The 1099s are super simple. We built the technology that basically speaks to our system. So we'll pull down the 1099 form automatically from the IRS's website. It'll then speak to the back end of the Yieldstreet system, the data warehouse, to understand like what's interest, capital, et cetera. What are those dynamics that need to be filled out? It'll pull that data relative to your specific portfolio and then immediately publish 1099. So we'll publish millions of these 1099s in an automated fashion. K1s are a bit more tricky. We're still very much beholden to the issuer of the K1. And our partners who are able to provide a more seamless experience in issuing K1s allow us to provide that same experience. The partners that take time and have extensions, we still have to do that. I do think that's been a learning curve for investors over the last number of years. The first time you invest in private markets and you find out that you're not getting your K1 till September, you're like, what do I do? What do I tell my accountant? You go through this emotional journey of what in the world's going on. But anyone who's managed to invest in more than one fund is now used to that, irrespective of where you get access to that. I think over time, it would be nice to see some more uniformity, but that's probably beyond the scope of Yieldstreet's broad capabilities. And that's more something that the industry needs to figure out. That being said, how you experience it on Yieldstreet is, again, beautiful, easy, seamless. So if I would pull up my app right now, I'd go into my portfolio, I'd click Tax Center, I can sort by year, by investor, by LLC, et cetera. Let's just say I wanted them all. I would just click download. It would zip it all into one file. I'd send it over to my accountant and that was it. I'm done. So we understand that a lot of the customers who are going to get access to products that have K1s probably have a preparer. And so we made it really easy to get the entirety of the file over to your preparer.
And what's your personal favorite investment right now?
Hold on a second. Let me check what's on. There's a delta between when I see them and when they go on, right? Between the investment committee. So let's take a look at what's on. I love using this app. So I'm the greatest cheerleader and the biggest critic. At midnight on Saturday, I sent my leadership team roughly 10 screenshots and 11 rants about things that could be better. I love this. I absolutely love this app. Okay. See there, just looking through it, this is where I just get so excited. All right. I'm a QP, so I'm looking through it through a QP lens, right? There's a Yieldstreet fund that's investing in a KKR credit opportunities fund, 25K minimums. That's amazing. Where is someone getting 25K access to KKR? We have a diversified CLO portfolio. I'd never had CLO access before this. It's an interesting business. It's consumer lender business, pays 9.25, 26 months. That's a really interesting deal. I want to see if the one here, Art Equity 5, right? So owning art, blue chip fine art has been reserved for the ultra wealthy. To be able to plunk down $5 million on a piece of art, especially if you don't know the space really well and have a lot of confidence, that should probably be sub 1% of your net worth. So if you want to be able to participate in the art market as an investor, it's really hard even if you're wealthy. And so Laura and Rebecca and the team have leveraged their experience underwriting as a lender billions of dollars of art over the years to create an equity fund where we actually go out and acquire blue chip fine art, put them in a fund format and let people get exposure. I think that's super interesting. Stepstone's VC fund. So Stepstone's a $40 billion manager, but we made it IRA eligible. How cool is that? And then we have a sports and entertainment credit fund where we're investing in Ares' strategy, which is just a huge boom right now, right? To be able to get into professional sports and franchise sports as you see further digitalization of everything we do, more games, more interaction.
So what does that mean specifically? Is that a piece of a team?
So they are investing primarily as lenders to professional sports teams. So they'll do like acquisition finance, or they'll do other types of financings or roll-ups. They have deep expertise in that space and have had stellar performance. And here we are investing within that strategy and giving people access. Here's one I just did personally, Power Sports Loan Portfolio. So that is it's a cool business, and the historical performance surprised me in a positive way. There's a company out there called Octane, and Octane, if not the largest, is a very large financier of toys, jet skis, ATVs, 4x4s, right? Power sports. So if you're going to go into a store and buy a $25,000 ATV, you're going to get financing on that. They're usually the ones behind that financing. We have invested I'm going to say ballpark, and I'll give a proper disclosure here. Anything we talk about investment should not be considered an offer, and anything else any lawyer would tell you is in this disclosure shall be considered in this disclosure. Basically, it's around roughly a $300 million deal. JP Morgan's the senior. It's a portfolio of 12,500 consumer loans backed by these loans to these specialty assets. It pays investors 13%. I think it's monthly pay. So it's great cash flow. It's a nice duration, really interesting business. I think it's a good example of something that a Yieldstreet investor is getting access to at a premium, in part because of where the broader capital markets are right now. So a year ago or 2 years ago, this thing would have traded at half the price. Legal finance, there's 2 legal finance strategies on here. It's crazy. Like, you're looking at this thinking that I'm a $100 million guy ready to invest, and you don't have to be.
You mentioned you have an investment committee. So what metrics are they actually using to decide what gets on that platform and what doesn't? Because I'm sure at this point you're seeing quite a few opportunities that you don't have room for.
There's a pretty extensive process from, if you look at sort of the investment side of the business. So there's an origination function that's going to go out and meet with top tier sponsors across each of these asset classes. And they're going to try and find what they would consider a qualified Yieldstreet lead or relationship.
What would that be? What do you mean qualified?
Could be 10 years in business. The easy ones that we spoke about were like KK and Aries, but let's say Octane. So how long have they been in business? How many billions of dollars have they issued? What's their historical performance in securitizations or other debt? So you'll go through that track record, you go through the performance, you look at that business, you try to understand what have they done when things went wrong. That's really important. And so once they get a sense that generally we think that this is a qualified partner, like we think we should take a deeper look, they'll then move into a cursory information gathering phase where they're going to ask for a whole host of due diligence questions. If they're still feeling good about that opportunity, they'll bring it to what's called a green light committee. The green light committee is designed to optimize the time of our team and be respectful of the time of our counterparties. And what I mean by that is you can end up working on any number of investments that won't make it through investment committee. And so the idea is to weed them out as quickly as possible. So the team is really spending the time and working on the opportunities that have the highest likelihood of being successful on our platform. And so the green light committee is basically where they'll come to a smaller committee and say, hey, here's what I'm working on. Here's why I like it. Here are some of the risks. What do you think? And at that point in time, if you get a no, that's easy. You go home. If you get a yes, it's usually yes, but we think you should look at these 5 things and make sure that these risks are covered. And it could be a regulatory risk. It could be a market risk. It could be how do interest rates affect that business. So it'll be any number of questions that may have not been called out specifically by the portfolio manager and what he or she intends to do between now and a credit committee. Ultimately, if you keep making it through the gates, you'll get to an investment committee. So the investment committee is probably only for maybe 15% of the product that shows up, maybe even less. Our desire is to weed out almost everything we think won't work before it gets to the committee. The committee is the most senior members of the firm, and so the time is valuable, and we want to make sure that all the work that's being put into for you to get to the committee is not for waste. And so there are a number of those gates, and then ultimately when you get to the committee, it'll be like any other sort of major investment committee or a major operation or major investment manager or major platforms committee. There's going to be a full presentation, a host of due diligence information to back that up. There's a lot of Q&A that happens before the committee. So there'll be a doc where different folks will post questions and seek to get answers, and those that need to have further discussion will make it onto the committee for discussion. Otherwise, we seek to get those answers prior to the committee. So once we get to the committee, there's a good, healthy discussion, but it's really the meatiest part of the necessary things to converse upon because we've flushed out all of the smaller points before we got there. Historically, we're a sub 10% approval, and I don't think we track that probably annually. Like, we're just curious, so we look back at it. We don't say, oh, we're only going to approve 10% or less. I think our diligence is that rigorous that it's what ends up happening. It could be 6% one year, it could be 10.5% the next, but it's typically inside 10% for the last 9 years.
What do the next few years hold for Yieldstreet?
My ambitions are slowly becoming more well known. Listen, I think there's a moment in time right now in the market where a lot of entrepreneurs are number one hurting. And I don't think a lot of people are good at dealing with rejection and challenging times and resilience. I think most people are either focused on keep my head in the sand and just grind it out, or pick my head up and try and do something big and entrepreneurial. I think one of the things that we have here at Yieldstreet that we're really good at is doing both. Like, we really know how to compartmentalize, and we've done it time and again, right? We acquired Athena, we created tremendous efficiency, we scaled the business. With Cadre, we're doing the same thing right now. And I have a couple more behind that I'm working towards. One I think is very promising, very big, will also take us international. By the end of the year, we'll have launched a fully blown and fully scaled secondary market for private investments. And then I think I'm focused on being able to take Yieldstreet beyond that first international location further east into India, Japan, South Korea, Singapore.
You're overseas now, right? Aren't you in Brazil?
We have overseas employees. We don't take dollars over. We just started taking investments in overseas. And so we didn't have offshore investment capabilities. I'm a firm believer that technology should transcend borders and currencies. And what we're building here in the US is felt in every other economy as well. And I think that we still are America, and America still is the number one sought after market. And so to bring the largest brand in private market investing abroad, I think is a very attractive opportunity for us and for those markets. So I think between now and 2030, we have a ton of things to do. There's huge support and tailwind. Like, the market is just growing quickly, right? It's growing in terms of the size of dollars that want to be invested in alts, but it's growing in recognition. It went from alts are nice to have to alts are required to have in your portfolio. And there is no experience like Yieldstreet, and there is no one who could deliver it in the way we have. And hopefully we find the right substantial capital to pursue that in a big way, and or the right partners to fuel that growth. So I'm super, super excited for the next couple of years.
Michael, thank you so much for joining us and sharing your wonderful insights with us today.
Thank you for having me. It was a lot of fun.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.